Welcome to this explainer. Today we're putting on our financial detective hats to investigate National Health Investors, or NHI. We're going to dive straight into the raw quantitative data to see if NHI is actually trading at a fair price right now. We'll be looking at the math, the margins, and the cash flow to give you a clear, unbiased picture of this company's true intrinsic value. Here's our roadmap for today. First, the big picture valuation. Then, pricing and multiples. After that, the dividend income story, followed by growth and returns. And finally, financial health and our final verdict. Let's get right into it. Section 1, the big picture valuation. Right out of the gate, our data spits out a calculated fair value price for NHI of $87.42 per share. Now, this number is our anchor. It's the benchmark we calculate directly from the company's financial metrics to figure out what the business is theoretically worth. But here's where things get interesting. Check out the contrast. NHI's last closing price of $74.63 sits well below that $87 fair value. So just doing the math, that instantly establishes a 14.63% margin of safety. If you're a value investor, your ears are probably perking up, right? This looks like a stock that might just be on sale. But we've got to be careful here. This leads us right into the core detective work of today's explainer. Does the underlying financial machinery of NHI actually support buying at this almost 15% discount? Or are we staring at a classic value trap where the stock is cheap for a very good reason? That brings us to Section 2, pricing and multiples breakdown. Context is absolutely everything in valuation. So, a price-to-earnings ratio of 24.07? Sure, in a vacuum, that might seem a bit elevated, but across the board, whether we're looking at PE, price to sales, or price to book, NHI is actually trading at a discount compared to its own trailing 12-month averages. Take the price to sales ratio, for example. It's roughly 11.5% lower than its recent norm over the last year. And we see the exact same pattern when we factor in debt and cash using enterprise value metrics. The EV to EBITDA sits at 17.33, which is nearly 5% lower than its trailing average. And EV to sales? That's at 12.11, so an almost 9% discount. All this data really just cements the narrative that relative to how it usually trades, the stock is historically cheaper right now. Moving on to Section 3, the dividend income story. Now, on the surface, the dividend story here is super compelling. NHI is boasting a solid 4.93% dividend yield, and it pairs that with what looks like a totally reasonable standard payout ratio of 75.68%. Basically, they're paying out about 3/4 of their net income as dividends. They also have 1 year of consecutive yearly increases, and the projected forward 10-year yield on cost pushes up to a very attractive 6.01%. Okay, but wait, as financial detectives, we have to look deeper, and the actual cash flow paints a much more concerning picture. The free cash flow payout ratio is sitting right at 100%, and that's alongside a free cash flow yield of negative 2.27%. So what does this mean for us? It means the dividend is severely stressing the actual hard cash generated by the business. They were literally paying out absolutely everything they bring in, and then some. Definitely a red flag. Let's turn to Section 4. Growth and returns. If you look at the yearly returns, you'll see massive volatility. Look at the swing here. We see a pretty significant dip in 2021, down 11.74%, but then, a few years later, a massive 30.71% surge in 2024. Currently, the year-to-date performance for 2026 is relatively flat, sitting just slightly down at negative 1.17%. So yeah, it's been quite a bumpy ride for long-term shareholders. Now let's look at the actual growth of the business itself. While the 3-year compound annual growth rates for both revenue and net income look stellar, they're both in the double digits, with net income growing nearly 17%, expanding our view to a 5-year timeline tells a radically different story. That 5-year net income CAGR is actually negative 1.49%. This really highlights a long-term inconsistency. Essentially, that recent 3-year boom is masking a broader struggle to consistently grow the bottom line over a longer horizon. And this inconsistency? It directly ties into our biggest red flag yet. Over the trailing 12 months, NHI has generated a negative free cash flow of over $82 million. Because they are burning cash at this kind of rate, their price-to-free cash flow ratio is completely broken, sitting at an extreme negative 44.06. Remember that 100% free cash flow payout ratio we just talked about? Well, this negative $82 million deficit is exactly why that dividend looks so precarious today. Finally, Section 5, Financial Health, and our final verdict. Crazy enough, despite the cash flow burn, the underlying business model is actually incredibly efficient at the top line. NHI holds an absolutely massive gross profit margin of 82.12%. It costs them very little directly in cost of goods sold to generate their initial revenue. And what's even more impressive is that a really healthy 39.62% of that revenue successfully cascades all the way down to the bottom line as net profit margin. Put simply, every time NHI makes $1 of revenue, they manage to keep nearly 40 cents of it as pure accounting profit. That is no small feat. Furthermore, NHI manages this profitability with a pretty conservative balance sheet. They've got a completely reasonable debt-to-equity ratio of 0.84, which means they really aren't overly leveraged. They also maintain a current ratio and a quick ratio of 1.39. This acts as a solid safety net, showing us they have more than enough liquid, short-term assets to easily cover their immediate liabilities. Okay, so let's summarize everything we've uncovered in today's investigation. We've got a clear standoff here. On the bull side, we have a deeply attractive valuation with a nearly 15% margin of safety, sky-high profit margins, a solid balance sheet, and a really appealing near 5% dividend yield. But man, that clashes directly against the bear case. Alarming negative free cash flow metrics, a dividend that is severely stressing the cash they do have, and a 5-year trend of net income shrinkage. Ultimately, all this data leaves us with one final, pretty provocative question. As an investor looking at NHI today, does that 14.62% discount to fair value provide enough padding for you to risk riding out the company's severe cash flow challenges? Are those sky-high profit margins and current asset health enough to keep the dividend alive while they try to turn the free cash flow around? Well, that is the puzzle you've got to solve. Thanks for joining me on this explainer, and keep digging into the data.